Uptrend, consolidation, downtrend. You have probably heard it 100 times. Every trading guru repeats it like a chant. But have you ever stopped and wondered, why does price even move that way? Because here's the truth, the market isn't just reacting, it's performing, following a script written by those who pull the strings. Every push, every fake breakout, every sudden reversal, it all serves a purpose. Smart money. Smart money moves the market in cycles, from building positions, moving price, and then resetting the story all over again. And once you understand that story, you stop trading what you see and start trading what's really happening. Because let's face it, how are you going to fight people moving billions with your $10 account, with your $1,000 account, or your $1 million account? That's like bringing a water gun to a wildfire. You see, most traders spend months memorizing chart patterns, stacking indicators, and chasing signals, hoping that one setup will finally click. See, the problem isn't the effort, it's what they have been taught to focus on. Because trading isn't about memorizing shapes on a chart, it's about understanding the reason those shapes exist. In this video, I'm going to break down market structure in a way you have never seen before. Simple, using real-life explanations that make each concept impossible to forget. But don't get me wrong, I am not here to teach you a new strategy or a new entry model. I'm here to give you something far more valuable: clarity. Clarity that cuts through every strategy, from ICT, SMC, ICC, or classic patterns. And this clarity changes everything. Beginners stop drowning in information, experienced traders stop overcomplicating, everyone finally sees the foundation every strategy sits on. Okay, let me not waste your time. Let's jump right in.
Okay, so the market moves in three ways, okay? Only three ways. It either moves up, okay, or it moves down, or it moves sideways. Now, when it moves up, it is called an uptrend, okay? When it moves down, it is called a downtrend, right? When it moves sideways, it is called a consolidating market. It is called a consolidating market. Okay, so now that we know the directions that the Forex market move, right? We need to know who or what moves the Forex market, right? So the individuals that move the Forex market are called smart money, okay? Smart money. So these individuals have a lot of money to trade with, okay? So who is smart money? So smart money, they include the banks or institutions, right? So we have big banks like JP Morgan, Citibank, and Goldman Sachs, okay? So they are the main drivers of the Forex, gold, and crypto markets, are we okay? And other markets too. Then we have hedge funds and investment firms. So we have BlackRock, we have Bridgewater Associates, and a Citadel. So they manage billions and execute large orders that shapes the market's direction. And we have the market makers or liquidity providers, okay? So they control liquidity spreads and often engineer price to fill large orders. So we have jump trading, street trading, Citadel securities, which might include some of these individuals, okay? Now, why are they important? Why are they very important? They're important because they have a lot of capital to trade, right, the markets with. Because sometimes we retail traders put expectations on the markets, right? So we expect the markets to go in a certain direction. And when it doesn't go towards that direction, we become frustrated. So I'm here to let you, or I'm here to assure you that the markets doesn't go towards your direction, but it goes towards the direction of these people, unless you have billions of dollars to trade with. Now, when you go to your chart, okay, most of the times you realize that before the market begins an uptrend, okay, it ranges for some time. It moves sideways for some time. So it can move sideways for a day, an hour, or maybe for 30 minutes before we begin an uptrend. So before price starts making higher highs and higher lows, higher highs and higher lows. Then after it is done making the higher highs and higher lows, it starts ranging again. So this is how price moves, right? It starts ranging again, then it will start making lower highs and lower lows, to start making lower highs and lower lows, lower highs and lower lows. Then when it is done with this movement, it will start all over again. So you can check your charts and then you can see the examples, or you can see what I'm talking about. Now, before I explain why the market moves like this, I have made a very short story on Mr. Chen, who is a Chinese businessman. So let's watch that story and then let's see how that story affects price action, or how that story relates to price action.
So, this is Mr. Chen. Now, Mr. Chen owns an orange juice factory, right? which means that he works with oranges. Not literally, but he needs oranges to run his business. Okay, now let's say Mr. Chen for this month needs 4,000 oranges. So Mr. Chen needs 4,000 oranges this month, right? He needs to go and get the 4,000 oranges. So Mr. Chen goes to his village supermarket. Now, when he went to his village supermarket, there were only 1,000 oranges present over there. And each orange was going for $1. So one orange equals $1. So Mr. Chen bought the 1,000 oranges for $1,000, right? Keep that in your mind. Now, he has 3,000 more oranges left, right? So Mr. Chen travels to the next village, right, to look for the rest of the 3,000 oranges. But when you got to the next village, there were only 1,000 oranges in this village too, right? But this time, one orange cost $2, right? So Mr. Chen bought all the 1,000 oranges, yes, because he has money, for $2,000, twice what he bought in his village, right? Now, Mr. Chen has to go to the next village again to get the rest of the 2,000 oranges. Remember, this village also has only 1,000 oranges. So Mr. Chen travels to the next village, and the same thing here. This village also has only 1,000 oranges, right? But one orange costs $3, right? So price has gone up $1 again. So Mr. Chen, having nothing else to do, bought 1,000 oranges again for $3, which cost him $3,000, right? Because he has to buy all the 1,000 oranges. Then Mr. Chen has 1,000 oranges left to buy again. Remember, he's buying 4,000. He has bought 3,000. So Mr. Chen travels to the last village and he gets also 1,000 oranges from there. But this time, the oranges in this village cost $4 each, right? Which means that Mr. Chen spent $4,000 to buy all the 1,000 oranges in order for him to run his business. Now, although Mr. Chen has a lot of capital or money, you can see that he's going to lose money on the long run because the price of the oranges were getting more expensive village after village, right? So Mr. Chen needs to look for a smarter way of buying the oranges, right? Or a more cheaper way of buying the oranges. So because he's rich, he hired messengers to announce that insects were spreading through orange farms and the fruit will spoil soon, making everyone rush to sell the oranges before theirs became worthless. So people started selling their oranges on a large scale to Mr. Chen and to other orange dealers, right? So through this, Mr. Chen was able to buy all 4,000 oranges cheaper than the $1 that he was expecting to buy from his village.
Okay, so I'm going to show you why price moves that way. But before I do that, let us quickly take a look at what is going on here. Now, when you look to your right, you're going to see a lot of values here. Now, all what you have to know is that as price moves up, the more the price moves up, the more expensive this currency pair becomes, right? So when price moves from 155 to 157, the currency pair became more expensive, or the price of this pair moved up, right? Now, why is that important? It is very important to know that because at each and every level, there are a certain amount of buyers and sellers that are sitting there, okay? So at each and every level of price, these are levels of price. At each and every level, there are a certain amount of buyers who are waiting to buy their market, or there are a certain amount of sellers who are willing to sell their positions. Very good. So, for the sake of this example, I'm just going to use 5 positions or 5 levels. So 1, 2, 3. So just 5 levels. 5 levels for the sake of this example. So let's adjust them. Okay, nice. Now, as I said previously, at each and every level, there are certain amounts of buyers or sellers that are sitting at each level. So for the sake of this example, I'm going to use sellers, and you're going to see why I'm using sellers very soon. Now, let's say price is currently at this position. So price is currently at this position, and then smart money comes to the market and they want to trade, right? And yes, smart money, they do trade. So let's say they've come to the market and then price is sitting here and they want to buy 50,000 positions. So 50,000 positions. So 50,000 positions or lots, right? But remember, at each and every level, there are a certain amount of buyers or sellers that are sitting there. So let's see, at this first level, there are 10,000 sellers that are sitting here. So at this level, there are 10,000 sellers that are sitting here. So let's duplicate that. Then at this level, there are also 10,000 sellers. This level, 10,000 sellers. This level, 10,000 sellers. The last level, 10,000 sellers, right? So at each and every level, right? Let's say there are 10,000 sellers sitting there. Now, smart money comes to the market and they have a huge order, a huge buy order. They want to buy 50,000 positions. Now, when they click the buy button, okay, so the way they enter trades is kind of different from the way we enter trades, okay? But let's just assume that they click a buy button, right? Now, when they click this buy button, what the market is going to do is that it's going to come to this level of sellers, because this is where sellers are currently sitting. And there are 10,000 sellers sitting here. Now, let's assume that each and every seller has one position. So the 10,000 sellers have 10,000 positions, right? Nice. So the 10,000 sellers have 10,000 positions. And then same for the other levels. Okay. So what market does is that it tries to fill all these 50,000 positions. So it comes to this first level here, fills all the 10,000 buy positions with these sell positions. Or simply smart money buy 10,000 positions from these 10,000 sellers at this level. Now, when they are done buying this 10,000 positions, they'll have what? 40,000 positions more left to buy, right? So 40,000 positions. So, because there are no more sellers sitting at this level, price has to go to the next level of what? Sellers, which will also, or this level of sellers are also going to have 10,000 positions. Nice. So, the market will come to this level, then smart money is going to buy, that's 10,000, right? So now they'll be left with 30,000 positions to buy. And the same thing happens for this position. They buy the next 10,000 and they have 20,000 left to buy. Then price goes here to the next level and then to the last level until they don't have any more positions to buy. So at this point, they would have bought all their 50,000 positions. So they have 0 positions left to buy. 0 positions. Now, you can see what happened to price here. You can see that price spiked up a lot, right? Price spiked up a lot. Price spiked up a lot. So it will look somehow like this. You see a big green candlestick. You see a huge green candlestick. Now, although this is good for retail traders, I mean, this is how retail traders make money. They make money when the price spikes up like this. But this is bad news for what? For smart money. Why is that bad news for smart money? It is very bad news because, as you can see, the price of this currency pair was getting expensive each level as we went up, right? So it was getting expensive after each and every level. So at this level, it was more expensive than this level more expensive than this level, and so on and so forth. Which means that they bought the positions at a more expensive price that they should have done. Now, smart money doesn't want to lose money. Although they have a lot of money, this is going to cost them a lot because their order is worth billions of dollars. And this slippage that occurred here, right? So we call it slippage. This slippage that occurred here is going to cost them a lot of money, right? So they don't want to do stuff that way. So instead of buying a huge order at once and the price spiking up, they have to think of a smarter way of buying. So just like Mr. Chen, they have to think of a smarter way of buying such that price will not spike up like that, so that they will not lose that kind of money that they are going to be losing if they buy or if they put all their orders in at once. So what did they do? So just like Mr. Chen hired his messengers to lie to the people about the market movement, smart money is going to try and keep the market in this range or in between these two levels. So you see that the market is here. Now, when you see this ranging occurring, right, sometimes you're going to see big red candlesticks, which means that the price is indicating to us that it might sell. Huge red candlesticks. And sometimes you're going to see breaks to the downside, right? Now, this is a perfect way of manipulating retail traders. That's the price is going to sell from here. Remember, retail traders trade with emotion. They trade with FOMO. So when they see that the price is making huge red candlesticks, they're going to see, oh, price is going to move down. Let's quickly sell our positions. Let's quickly sell positions. So instead of everyone waiting to sell their positions when the price gets higher and higher, they're going to think that the price is going to reverse from here. So they're going to start selling their positions here. So instead of smart money waiting to buy more positions at each and every price point, they're just going to manipulate everyone into thinking the price is going to move down from here. Then everyone sells their positions to them. So they buy all the 15,000 positions at this level when price is between this box. Now sometimes they manipulate our sentiments. So sometimes you see Elon Musk tweeting that crypto is going to crash very soon, and then you see people selling their crypto only for smart money to buy them and then start an uptrend. So this is how consolidating markets okay. So now smart money has bought 50,000 positions, right? So now they are holding 50,000 positions. Now what this means is that there are no more sellers trying to push this market down, right? As you can see, all the sellers have been removed from here and have been forced to sell here or manipulated to sell here, which means that the only way that price can move now is up. Now, why is that so? Let's say there was one tomato left in this world, just one tomato. All the tomatoes have gone extinct. What do you think will happen to the price of this tomato? It will move from one tomato equals $1 to one tomato equals $1 billion, right? Because this tomato is the last tomato. What does this mean? It means that when there is no supply, right? No supply, or less materials, right, to sell, the price of that material goes up, right? So when there's less materials to sell, the price of that material goes up, or the price of those materials go up. So you can realize that when there's no oil, when there's lack of oil, or when there's no diesel, the price of diesel goes up, right? Because the supply is low and the demand is very high. People want oil, but there's no oil, so price of oil goes up. Now the same applies for this. So because smart money has almost all the positions, and now people want to buy the positions, the least buying that anyone does can start an uptrend. So when the uptrend starts, smart money will start taking their profits, right? So when they start taking their profits, you're going to see that the price is pulling back, and then they'll buy more positions here and they'll push the market up, start taking another set of profits and buying more positions here, taking profits and buying more positions. Now let's say the market is at a point where smart money is tired. They've made too much money, they're tired of making money, and they want to sell all their positions. So they want to sell all these 50,000 positions. So right now they are having 50,000 positions, and they've driven price so high that they are tired and they want to sell, right? They want to take their money and leave. Now, if they were to sell, they are going to have to sell to who? To buyers. If you want to sell your product, you have to sell to people who are buying. Now, just like the way at every price point, there are a certain amount of sellers that are sitting there. There are also a certain amount of buyers that are sitting at each and every price point. Remember, people want to get into buy positions, right? Because they think this uptrend is going to continue. So people want to buy. So let's say there are 10,000 buyers sitting here, right? 10,000 buyers. So 10,000 buyers. So there are 10,000 buyers seated at this point. And then at this point, there are also 10,000 buyers. Then there are 10,000 buyers at these 2 points. And the last point, there are also 10,000 buyers, right? Now, if they want to sell these positions, they have to sell to what? Buyers. And at each and every point, there are buyers that are seated there. Now, people think this uptrend is going to continue. So yes, there are people that are going to buy this position from here, you know. So let's use the same scenario that we did from here. So if smart money just clicks the sell button right from here, right? If they just click the sell button right from here, what is going to happen is that because there are only 10,000 buyers here, the smart money are going to sell to just these 10,000 buyers, which means that they will have 40,000 positions left to sell, right? After selling to these buyers, then price will move to the next level of buyers to look forward more buyers to fill these sell positions or to exchange these buy positions with these sell positions, and so on and so forth. So price will move from this level to this level to look for more people who are buying to exchange these orders. So at this point, smart money would have sold 30,000 positions, which means that they have 20,000 more positions to sell, as you can see. Then price will continue moving down to look for more buyers to sell these positions to until we are done selling, right? So when you are done selling, we'll have 0 positions to sell. Now, as you can see, the market crashed very hard. Why? Because the price had to go and look for levels of buyers to sell this huge sell order to. So you can see that smart money is going to lose almost all the money they made during this uptrend. They're going to lose almost all because the price is going to be looking for levels and levels of buyers. And as price goes down, the value of this market, right, or this currency pair becomes low, as you can see. So smart money doesn't want that. They don't want that. They want to look for an efficient way of selling all the 50,000 positions without making or creating any suspicion. So again, they are going to manipulate us into buying all these positions right in this range. They're going to manipulate us to buy all the positions at this range. Now, in order for them to manipulate us, they have to use the tricks that they used here again. So you'll be seeing huge bullish candles, and sometimes you see a break. For people who see the break, they'll think, for the FOMO traders and the traders who trade with fear, they're going to think, oh, price is going to move up, let's join the trend, only for them to get smoked out later on. So these are the first level of buyers that are going to be cleared, the FOMO traders, yes. So after they are cleared, price moves down and then sells all the positions, right, in this box. So in this range, smart money are going to sell all their positions here. So they are going to manipulate people into thinking that they are going to sell here. And you might be wondering or asking, who is dumb enough to buy here, right? Well, I think that's us. Yeah, that's us. We are the ones who buy from here because we are trading with emotions. Now, when they are done doing this, right, when they are done selling all their positions, they have to reset the story all over again. So they're going to just start an uptrend again by shorting the market. So they'll start selling the market, pushing it down until it comes back here, and they repeat the whole process all over again, right? So now that you understand why the market moves the way it does, or why the market has to move the way it does, I think this should help you develop a lot of patience. Okay, so because I had to keep the video well under 30 minutes, I'm going to have to make another part and show you examples of the illustrations that we just made. So make sure you leave a like and subscribe and turn on the notifications button so that you see the example in which we are going to break down in the next episode.